I was reading about the Japan elections and Wall Street's reaction to it, the hedge fund insider analysis. Then I was reading mainstream news, and I was surprised because the stories are polar opposites. I think you deserve to understand the difference between what those who understand financial systems do and think about how Japan could be a catastrophic risk for US investors. Right after the election, Japanese interest rates spiked to their highest level since 1999, more than 25 years ago. And if you own any US stock, which most people do, you need to understand what's happening right now because there is $1.4 trillion of money sitting in Japan that could move US markets overnight with no announcement. Let me break down exactly what happened in the election, why it matters for your portfolio, and then give you a framework for protecting yourself and maybe even profiting from this, but only if you understand what's actually going on. Japan just elected a new prime minister, Sanae Takaichi. She won a landslide victory, a 2/3 supermajority. That means she has unlimited power to push through whatever policy she wants. No gridlock, no compromises, just unfiltered whatever she wants. Who is this person? 3 things you need to know. 1. She's a big nationalist, focused on Japanese identity and defense. 2. She's a China hawk. And 3. The one that really matters to you, she's very pro-stimulus. That means money printing, economic stimulation. She wants to spend a lot of money. She's promising massive government spending programs, tax cuts, a 2-year suspension of the food tax. Her message to Japanese voters is, I'm going to put more money in your pocket, and I'm going to spend more on everything. If you're a politician, that's what makes you popular. But what it actually means is they're going to flood the system with money and hope it works. Sound familiar? We've seen this before. Because the thing about printing money, when one central bank does it, all other central banks eventually do it too. It's a race to the bottom. Japan prints money, their currency, the yen, weakens, and other countries now have to respond or their exports become more expensive. So everybody does the same thing. A fiat currency race to the bottom. And there's really only one thing that wins. We'll get to that in a moment. So what happened right after the election? Markets freaked out. Japan's 10-year interest rate went to 2.35%. In America, you've been used to 4 or 5% interest for a while now. But for Japan, this is insane. This is historic. It's the highest interest rate in 27 years. Why should you care if you're in New York or Ohio or London or wherever? For the last 30 years, Japan has been in the land of free money. Interest rates were 0, sometimes even negative. Imagine if you could go into a bank and they pay you to borrow money. That's been Japan for 30 years, and now suddenly you actually have to pay interest. The market freaked out, and the new prime minister saw the reaction and went into damage control. She used the phrase fiscal responsibility. She's going to spend money but try not to completely blow up the financial system while doing it. So rates have come down a little bit. As of now, we're at 2.2 something. But that's still pretty extreme. You might still be thinking, okay, why should I care? Well, there's something called the carry trade. Let me explain it in simple terms. Imagine you have a friend who loans you money at 0% interest. Free money, free loan, no strings attached. And you take that free money and invest it into something that pays you 5% a year. You buy a US government bond. So you're making 5% on free money, free profit. That's what Japan has been doing for years with trillions of dollars. The real version is this. Japanese investors borrow money in Japan at basically 0. They convert that money to United States dollars. Then they buy US stocks, US real estate, US everything with it. They collect the returns, the 5% or whatever. Then they pay back their 0% loan in Japan and pocket the difference. That's been one of the biggest free money trades in the world for decades. But what's changing? That 0% loan is no longer 0. It's now over 2%. US interest rates have come down at the same time. They're no longer 5%. They're now 4%. So the gap, the profit margin, is getting smaller and smaller. Because they have to deal with currency risk, there's cost there too. This trade is starting to end. Now, why is that a problem? Because if they want to unwind their trade, they have to pay back their loan in Japan because it's now too expensive. They need to sell their investments. Where are their investments? In the US. US stocks, US bonds. More selling means what? Stock prices go down. And when stock prices go down, you kick off this whole automated selling thing with ETFs and pension funds and leveraged funds and margin calls. Japanese investors are some of the biggest owners of US assets. If they start to sell, you're going to feel it. We got a preview of that in 2024. Japan said we might increase interest rates, and the US went into a mini meltdown because this trade was starting to unwind. If you're thinking, what does that mean? Should I sell? How do I protect myself? That's exactly what we need to understand. The biggest mistake retail investors make, I've seen it thousands of times. They have beautiful profits. Something is up 20, 30, 80%, whatever. And then they watch it go back down to zero, maybe even negative, and they never sell it. Let's talk about what you can do to protect yourself. But first, let me explain another pile of money we need to bring into this. This one is controlled by the Japanese government. Japan has $1.4 trillion in foreign reserves. This is money the government holds, mostly US dollar assets. Remember, the new PM wants to spend a lot of money. Lots of it. Tax cuts, stimulus, defense spending, all of it. But she's also promising to be fiscally responsible so she doesn't blow up the stock market on day one. So she can't borrow endlessly and just print money endlessly. Where's she going to get the money? This is the clever or scary bit depending on your timeline. Japan has this thing called a special account for managing their foreign exchange. This account just posted a surplus of about 5 trillion yen. Takaichi is eyeing this surplus fund to fund her tax cuts without borrowing more money. What does it mean? She might sell US government debt to fund Japanese tax cuts. She's raiding the piggy bank that holds American IOUs. Think this through. If Japan starts selling US debt, what happens? First, more US debt for sale means prices drop and interest rates rise. That's how bonds work, never intuitive. Next thing that happens when US interest rates rise? Your mortgage costs go up. Your car loans go up. Financing costs for companies go up. Companies have to pay more to borrow money, and higher costs mean lower profits, which means stock prices fall. It also means the dollar gets stronger, which hurts US exports. It's a chain reaction that starts in Tokyo. Here is where I see this going. If Japan floods their system with stimulus money, which I think they're going to do, what's the Fed going to have to do? They'll have to keep rates even lower to avoid a debt spiral. You've got Japan printing money. Europe is printing money to stay competitive. And America is going to keep their rates suppressed because that's what's needed to keep debt affordable. What does it mean for your dollars? Your dollars are melting slowly because when they're printing more of it, it's worth less. Very simple. So what wins? What's the thing we should be doing right now? Gold wins, silver wins. Things they cannot print win. Why is there apparently support for this leader who could threaten US stock markets? Japan has promised to invest $550 billion in the United States. Tariffs on Japanese goods were lowered in return. They signed a rare earths deal which is important for tech and defense. This looks like a win-win politically. Both want more defense spending. They're both tough on adversaries. Both believe in strong national identities. From a geopolitical standpoint, this makes sense. But there's also endorsement of a leader who could really hurt American investors if stimulus gets a little out of hand. If she prints a little bit more than people were expecting, that carry trade unwinds, US stocks sell off. If she needs to fund her tax cuts through selling debt, she's going to be selling US debt, which makes US interest rates go up, makes the dollar go up. The new prime minister just won a supermajority. She has more than 2/3 of all seats in parliament. The opposition party literally has like 3 seats left. She can basically do whatever she wants, and she's probably going to want to do that. These kind of situations are where real money is made and lost if you don't know what's going on. When you see a situation with this many moving parts, currencies, interest rates, global trade, it's hard to comprehend. What can you do? You could do nothing. But if you do nothing, you're at the mercy of forces you don't understand. That's the worst thing. The second worst thing is to panic sell because you're going to get scary headlines and they're going to come quite late. What's the best thing? Understanding the structure, having a framework. There's always a pattern. We're not reinventing the wheel. We're following the same thing again and again. What's the golden rule here? It's a literal golden rule. When governments start printing, you don't fight it. You own what they can't print. That's gold, that's silver, and that's high-quality companies with real earnings and low debt that can survive whatever comes next. Zombie companies loaded with debt get crushed. What does the math say right now? Own what they can't print. First step, follow the money. Ask yourself, where is big money moving and why? In this case, the carry trade has been flowing from Japan to the United States for decades. Now that flow is threatened. When that reverses, U.S. assets get sold. How do we know if that's going to happen? Watch Japanese interest rates. If they keep rising, more money leaves the U.S. Watch the yen. If the yen strengthens, it means Japanese investors are bringing money home. Watch Japanese investor positioning in U.S. markets. If you know where to look, these data points are pretty easy to find. If you see that happening, consider reducing exposure to rate-sensitive U.S. stocks. The highest risk stocks, the high debt stocks, the new tech stocks. Number 2, identify what's the pressure point. What sectors or assets are most vulnerable to this? U.S. stocks that rely on cheap borrowing. Growth stocks, tech companies with lots of debt. Real estate, commercial real estate that depends on low interest rates. U.S. government debt itself is an issue. But that same pressure also creates opportunities. If U.S. rates go up because of Japanese selling, U.S. banks could benefit. The dollar strengthens. It helps some companies that import goods. Most importantly, you want to have an exit plan. You don't want to prematurely run for the door. That's what people often do. They worry about this, so they sell everything. That's not what I'm saying. Stay invested in tech and growth stocks and all that until you see big money starting to leave the building. Then you want to get out. Obviously, you have to come to your own conclusions. Plan your exit before things hit the fan. Sit down and look at your portfolio. What of this is most exposed to the carry trade? What's most exposed to high interest rates? Then automate your sell rules on those things because when stuff goes down, emotions kick in and it's very difficult to make decisions. When you pre-plan it, it's a lot easier. Look at the gold and silver story. Use the dips, the forced selling, as opportunities personally. Again, you have to come to your own conclusions. Shift towards quality stocks. Really boring big companies with very good numbers and fundamentals and earnings and low debt. These companies have something unique. They have products so good or customers so loyal that they can raise their prices no matter what happens. If we get more inflation, which I think we will, you can be in gold, but you might also want to be in some of the greatest businesses in the world because they have the ability to simply raise their prices and go up faster than inflation. Let me bring this together. Japan just elected a new prime minister. Her mandate is to spend big and cut taxes. That's pushed Japanese interest rates to their highest level in more than 25 years. Higher Japanese rates threaten the carry trade, which means Japanese investors may sell U.S. assets. It also threatens the $1.4 trillion that Japan owns in U.S. debt, which, if sold, would push up U.S. borrowing costs. This is not a crisis yet. You don't want to know about it when it is a crisis. You want to know before it becomes one. It's a big risk most investors aren't aware of. Being aware of risk before crises means you can protect your growth, profits, and wealth. My belief is Japan is going to print money. Other central banks will print more money faster, especially the US. It's a race. Your paper money is the loser. Your salaries, savings are the loser. But hard assets like gold, silver, real estate, and high-quality companies will do very well. Companies that get government spending money will benefit. Think defense stocks. Think real assets, companies with fortress balance sheets. When governments print money, you lose with paper. You can create more of anything and it becomes worth less. Very simple. When governments start printing, own what they can't print. Follow where big money moves. Identify pressure points in your portfolio. Plan exits before emotions take over. Shift toward quality that can survive and thrive regardless of what central banks do. That's how you protect yourself when a Japanese election threatens to reshape global capital flows. That's how you turn potential crisis into opportunity. Not by panicking, not by ignoring it, but by understanding the structure and positioning accordingly before the crowd figures it out.